And a big welcome to our live audience for the Digital Health Investor Talk show. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me at x.com/Stephen Wardell. Our show today is on the topic of the healthcare AI arms race with Fawad Butt. Fawad is the co-founder and CEO of Penguin AI, a GenAI product company that is optimizing the healthcare back office for payers and providers. He is the former chief data officer of Kaiser Permanente and had the same role at United Healthcare and Optum. This show is being recorded and will be included in our podcast series called Digital Health Investor Talk. Subscribe to our podcast on Apple and Spotify and leave us a review. We always love getting new reviews. We have a new podcast links for the show, so make sure that you see recent episodes when you subscribe, or you could be subscribing to the old page of the old podcast. This is not investment advice, and we are not investment advisors. Here's the format of today's show. It's 90 minutes long, and Fawad and I will spend the first part discussing the news and the macro picture and some other topics, and then we'll focus on our special topic of the day. And we'll be taking questions throughout in the show through the LinkedIn text chat. Welcome to the show, Fawad. Great to see you.
Well, thank you very much for having me. Excited to be here.
And can you please introduce yourself to our audience?
My name is Fawad Butt. I am the CEO and co-founder of Penguin AI. As Steve mentioned, it's a company that has built a platform to help healthcare organizations build and deploy AI agents, especially as it pertains to the administrative side of the house. This would include things that are typically back office or front office, such as prior authorization, risk adjustment, revenue cycle management, payment integrity, and a lot of the other processes that underpin our healthcare and care delivery as well as insurance system.
Great, thank you. So first, we'll move into our first topic, and that is macro news. And here we just talk about things like inflation, interest rates, especially as it affects young companies, young healthcare companies. And so I guess the first story of the day is a possible new trade war with China. There was a big scare on Friday about this. There's been some walking back of the scare today. Stocks were down a lot on Friday. They're up today. But I think in general, the trade war is bad for the innovation economy in a number of ways. First of all, trade wars, they boost inflation. And second of all, we get a lot of our healthcare products from China, and that becomes more expensive, although there is a strong national interest in having some products be independent of China. It also just creates general uncertainty. And we want the economy to be predictable, and we want people to be able to make deals, and we want investment to continue and to be as predictable as we can. So, and a true trade war can cause an economic downturn, among other things. We don't want that in the short term either. So, but Trump has walked this back a little bit, and the stock market has rebounded a little bit. So, any thoughts on that? On this trade war, and will it affect young companies innovating in healthcare and the payer provider dynamic in healthcare in general?
I mean, I think for the most part, it probably has limited impact on the healthcare ecosystem. I mean, although there are lots of drugs that are manufactured in China, including generics and so forth, that could be impacted. My understanding is that those are excluded from the tariffs and the trade war in general. So I don't think it has a direct impact in the classical sense. If you're a hospital and you source a lot of equipment, or if you're building a brand new hospital, if you're Kaiser Permanente, UPMC, one of these large health systems, and you're building a new hospital, you're probably sourcing tens of thousands of products. And there's a high likelihood that some of those are coming from countries where we may be in a trade war scenario. I think that is where it probably has a deeper impact, is when there are physical goods involved. Most of healthcare in the U.S. is primarily a services business, so I think it's fairly immune, minus the drugs and some of the equipment that we bring in. So I think we're pretty well insulated for now.
That's great. Thanks. And then, so the NASDAQ was at a near all-time high level, having fallen a little bit on Friday, but at 22.7 thousand. And so, but many people have pointed out that this high level and this lift over the last couple of years has come from the Magnificent 10, from the AI companies in the NASDAQ, and that the rest of the economy is not doing so well. And there's concern of a bubble here, an AI bubble. And the specific bubble is that these stocks are up, except for NVIDIA, these stocks are up on the promise of future profitable products. And they've made capital investment today. Sometimes their margins have gone down today because they're providing new unprofitable products. But the promise is that they'll make it back with higher earnings in the future based on profitable products. And so the bubble would be if they're not going to make it back in the future based on, and then we hit some earnings days when the market gets impatient. And so I'm wondering, do you have thoughts on whether we're in an AI bubble or not right now?
Look, I think there's definitely a lot of exuberance in the marketplace around AI, but I also think, being a data person, it's important to kind of break and look into the data. Yeah, there is a lot of exuberance, but it's because the data shows that AI is driving much of for example, the capex in terms of technology. AI is driving a lot of the hiring. AI is driving a lot of the revenue as well that is sort of being optimized at existing companies, but then created out of nowhere for companies like OpenAI and Anthropic and others. So I do think that there is exuberance. There are probably lots of companies just because they have AI in their name that they're being lifted, and investors are probably not doing the right research that they probably should be, which happens in every cycle. We saw that with the internet bubble in the 90s as well. But I do think that there are real legs to this technological innovation. I think, what's the last time we had a big technology shift? It was SaaS maybe. And if you look at the spend that kind of underpinned that, it was hardware, it was data center expansion, but it was pretty much very predictable workloads. You just were needing a lot more of those. What you're seeing now is a brand new type of a workload, which requires a brand new type of a processing unit, which requires brand new types of infrastructure and connectivity and memory and storage. So I do think that this is an area where you're going to see new companies made. We've seen NVIDIA do what it did. We've seen what happened with AMD last week when OpenAI just sort of disclosed that they were doing a deeper partnership. So I do think that they're real winners out there as well, but it's inevitable that there are some companies that are just being lifted because of the tide sort of rising.
Great, thank you. And for our audience, feel free to throw in any macro questions that you have for us to. So in other news, the Fed will have its next meeting October 20th, 29th. I think the expectation is that the Fed's going to cut 25 basis points again. So, and I think that's a good thing for the innovation economy. It's hard for young companies to raise money right now, and bonds are attractive as compared to growth in the economy because the base Fed rate is so high right now. And so I'd like to see some of that loosening and Fed rate cutting there. So that's and so we'll see. I think if they do cut rates, I think that could also address. There's concern that we have skipped a recession, that you don't usually get to skip recessions, but we've been overdue for a recession. We may have skipped a recession. Cutting the rates, we don't want to go into a recession, so cutting rates will help us avoid a recession. Anyway, so I'm predicting a 25-point basis cut, and if that happens, the market will continue to climb. If it doesn't happen, you'll see the market pull in a little bit, but I think we're in a cutting cycle. So, Fawad, any thoughts on the Fed and rate cuts?
Yeah, I think so. I think we've had a pretty funky cycle over the last couple of years. We had, lots of new money entering the markets and systems, and then we saw the inflation that came as a result of it, and then ultimately the tightening of the Fed funds rate and so forth. So I think those are all par for the course, but we've been in this cycle for a few years now, right? I think it just feels natural for us to be sort of slowly coming out of it and out of a tightening environment. Now there are other macro things that we talked about, such as trade wars and others that may be muddying the water a little bit in terms of what the actual data looks like. But I think the consensus is 25 basis points. I think it's pretty much baked into the market. If you ask me at this point, 500-point rally that you saw today is not just because I think of a comment. I think there's anticipation of a loosening of the policy there. So yeah, I think you're right. I think if we don't see the rates come down, or at least an indication towards that, on a continuous basis, you're going to see the market reverse pretty quickly.
Great. And are there any macro stats that you follow or macro stories you want to bring to our audience?
Yeah, look, I think the big macro story, I think that's sort of top of mind for us is in healthcare, right? Which is the fact that delivery of care has gone up quite significantly, as is evidenced by the health insurer stocks and their margins going down, right? So if you look at when you see a company that's a bellwether like United Health Group, see their stock halved over the course of 6 months. That's just a historic moment that says that there are underlying fundamental shifts happening in the industry. And I think the trend to watch is one of the biggest trends to watch is the medical loss ratio, right? Which is the amount of money that health insurance companies are spending to deliver care to the patients that bought that insurance. So those numbers typically used to be somewhere around 79, 80%, meaning for every dollar you collected as an insurance premium, you paid out about 80 cents or so in actual medical services and care. Those numbers, especially for the aging population that we have, the Medicare Advantage plans and so forth, that population, that number has over the last year and a half gone up from 80% to in some cases 90+ percent. And that's just a major, major fundamental shift. I think that drives a tremendous amount of it has tremendous impact both on spend, on margins, on productivity, on cost to government. So that's the one I track amongst the larger insurers, especially like Elevance or United Health Group and Aetna and so forth. I think those are the ones to see. I think for the last 4 to 6, maybe even 8 quarters, depending on which insurer you're looking at, those numbers have been trending upwards. And I think unless we see a stabilization of medical loss ratios and then a gradual decline of it, I think the industry is going to continue to go through major, major shift and turmoil.
So, of course, employers in America think it's absolutely terrible that premium costs keep rising at fast rates. And it sounds like we're in store for more of that. How will that be resolved? Plans will come to employers and want higher premiums, and but is it a one-time jump in premiums, or what do you think?
Look, I think it's going to be multidimensional, right? So one is that plans are going to come with their actuarial numbers and show it to the employers and say, for this population that you have this year, it's going to cost X, and it cost you, X minus 5% last year, or whatever the inflation happens to be. So I do think that that's going to happen. In some cases, the employers are going to have to accept it just because there are very few levers. But in other ways, I think employers don't have unlimited funds either, right? So they've seen inflation in other categories, whether it's materials or their own service costs. So they're going to probably, one of the things they're going to look at is plan design, which is going to be, well, should we be cutting some benefits to offset this? How much of the burden should we be bearing versus the employee for this increase? Are there other ancillary things that we could cut off, which may cost, X percentage of what the increase is, just to offset it? So I think there are a number of categories of reactions you're going to see. I think for the larger, more profitable companies, mostly in the tech space, you're going to see probably more of an absorption of that cost. But I think for more blue collar industries and beyond, you're going to see a lot of that turning into passed down costs for the employee and or restructuring of the plan to reduce benefits. So I wouldn't be surprised, Steve, if we see some of that work its way through.
So now we're moving on to the next part of the show, which is talking about public policy, the ongoing government shutdown, news about Trump. And so what I'm hearing most recently from the healthcare sector is concern about impending government layoffs. And so the thinking is that, and so they're especially concerned about layoffs in CMS around grants or layoffs in FDA around approvals. And so the thinking with approvals, for example, is that, let's say that pharma can't do clinical trial spend if it can't talk to people at FDA, for example, because those people might have lost their job or gotten reshuffled in the last round of cuts or in the current round of cuts. And so this is causing a hesitancy. I like to speak on behalf of young software companies that sell into the big budgets of healthcare. And so this is software companies selling into pharma. But there's concern around CMS grants and also science grants as well, that the priorities are being changed, grants are being cut, and this causes a lot of uncertainty in basic research. And then also cuts at FDA. If your old contact there isn't there anymore, it's just harder to move your product through FDA approvals. So any thoughts on, looking back now, let's call it 4 months, including very recently, what are the Trump policies you think are having an effect on, or other government policies that are having an effect on your sector?
Look, I prefer not to comment on any particular administration or individual's policies, but I will give you a macro opinion on this, which is that, look, I think if you're a drug company and you have a drug pipeline which is heavily dependent on FDA reviewing your data, your results, and validating it, you have to be worried if these rumors are true, and if the number of people that are responsible for reviewing these outputs is going to go down, because I mean, supply demand kind of matters here, right? So the supply of people that can do this work is pretty small to start off with, but if you start to cut that even further, I think there's material impact that could happen. So if you're a pharma company, I'm sure you're working your lobbyists, or you're working your relationships in a pretty robust way right now. So I see that. I think that's a risk for the industry, because new drugs do matter. I mean, look, we were just talking a few minutes ago about medical loss ratio. Part of it is that, if you want to have an impact on medical loss ratios, you need to have a continuous pipeline of new technology and innovations in healthcare. And in many cases, that shows up in terms of drugs, new drug development and availability. So I do think that this is a counterintuitive problem, meaning that on one side we have an aging population that needs more of these things, and on the other side we may be chopping off some of the people that are responsible for approving these. So I consider that a challenge. I think that's an issue. CMS also is responsible for big chunks of the U.S. healthcare spend now, especially with Medicare and Medicaid programs. And so I think there's genuine concern about changes that are occurring in policy and in program design there, which I do hear from.
So other public policy news, I think that the large LLM companies are concerned about what California Governor Gavin Newsom is doing right now. Can you do you have a view on this? Can you tell us what's going on there?
Yeah, look, I mean, I think it's I did a post on LinkedIn about this topic specifically because there's a lot of hoopla about regulation right now in AI. I think there excitement both for and against it. So there was a lot of hoopla about what does this mean. So the reality is that this is a very basic regulation that's been passed in California. It doesn't really apply to many companies in the space other than some of the largest ones. I think the threshold there is that you must have $500 million a year in recurring revenue or revenue in general for this regulation to apply to you. But they're not asking for anything silly. I think they're just saying, look, just report to us when there are incidents. If you see problems that are, make sure that you deal with them and address them. I just don't see a lot of teeth here. I don't see a lot of companies that are impacted. You can count on one hand the number of companies that are going to need to comply with these regulations, and then even then, I think it's vaguely written enough where compliance could mean a lot of different things. So whether you're for or against regulation for AI, I would say this is pretty basic. It doesn't really change too much. It does introduce some basic hygiene around large language model companies and what they should and could be doing. And I think most of them were doing this anyways. But it's, in terms of regulations, I would say on the spectrum of being mild to being severe, it's probably on the milder side.
And most U.S. states have legislation that's been introduced, creating rules around AI, and that's been pointed to as a potential hazard. What if a national company had to figure out how to obey rules in 50 states? Do you have any thoughts on pending state legislation and the idea of federal laws trumping or ending the need for this?
Yeah, I think I prefer regulations to be more consistent. We do have a state and a federal system which allows us to test things at a state level, and then in some cases we'll adopt it at a national level. So I wouldn't be surprised if we go down that same path here. The challenge is that if you're a smaller company and you are like us, for example, and there are 50 states that have 50 different AI regulations, and some of them are vaguely written and some of them are precisely written. I guess one of the largest departments I would have to hire would be compliance, right? And regulatory and legal. And for technology startups, that's not where you should be spending most of your money. So I look back at it and say, when we did some decent things when the HTTPS protocol came out, when the browser was invented, when the internet became a real thing, we let it play it out for a little bit before we started to before we even knew what regulations were important. I feel like we're kind of in the same cycle with AI. We don't even know what regulations are going to be meaningful. We just feel the angst in the population, and therefore, in some cases, lawmakers are in a hurry to go and enact them. But my sense is that you got to let this play out a little bit. If you want smart regulation, if you want regulation for the sake of regulation, there's no stopping anyone. If we don't even know what the problems are fundamentally that we want to safeguard people against.
So we have a question from the audience from Patricia. I noticed that many employers with commercial plans heavily encourage signing up for plans that have employer cost containment, employee monthly fee containment by alternative options, such as employee has option to purchase high deductible plan out of pocket before employer pays, instead of employer providing a low deductible high monthly fee plan. So yeah, so that's been, Patricia, that's been an issue for a long time. Employees offering high deductible plans, perhaps with an HSA as well, with the idea of making employees cost conscious on dollar for dollar spend out of their own pocket for the first 6 months or longer of the year. I think that'll grow in the future. It's a way that employers have of offering lower premiums and shifting costs onto employees. So I think you'll see more of those offered, and you'll see fewer of the sort of deluxe or Cadillac plans offered in the future. I think that's in our future. Fawad, any thoughts on that?
Yeah, I think as we talked about it earlier, I think the first reaction is going to be, for employers, with the exception of a handful that have really high margin businesses, is going to be to push this down to the employee and try to absorb as little of it as possible. And so I expect that trend to continue. I think we're in for premium increases by all forecasts. If you look at some of the forecasts that Kaiser Family Foundation published, some of the other forecasts that have been published in other journals and reputable newspapers, it's pretty clear we're going to see a premium jump. There's a shift that's happening in the public, in the markets, in the insurance marketplaces. There's a shift that's happening overall in our population. There's a shift that's happening in government spending. There's a shift that's it's all going to impact the cost structure. So I do expect that. And I expect in many cases the employees to bear the cost.
So now shifting on to just a discussion of the fundraising, consolidation, and IPO environment. So we have near record NASDAQ levels. The IPO window opened up in the spring after a few years of being closed. There's 100+ digital health unicorns that would love to go out. But since then, we actually haven't seen that much action. We've seen the IPO of Hinge in May and Omada in June. Heartflow in a different sector IPO'd. The results have been a little mixed of these IPOs. And I would have thought we would have seen, 10 more lined up filing S1s. We haven't seen that. We haven't seen more since June. And so this has been a bit of a disappointment. What the market's telling us is that companies, they need to either be profitable or have a straight line to profitability. They need to have good market dynamics, and they need to meet their earnings estimates. And so maybe many of these unicorns, many of whom are 8 to 14 years old, don't have those high quality fundamental characteristics, which would be too bad if that's the case. And so any thoughts on, and so I think we'd like to see a lot more IPOs in the market, but we're not seeing it. Are you hearing things, and do you expect us to see a lot more IPOs in December?
Look, I think it's that the investors that invested in these companies 10, 14, 12 years ago want some liquidity. So it's not that that there is an interest from investors, and investors usually get what they want. So there's got to be something else going on. So what is it that's going on? Is it that these companies have existed and they're not profitable? Probably unlikely. I'm sure they in many cases they are profitable. But the challenge that I think a lot of companies are seeing or going to see over the course, if this window of IPO opportunity continues, is that certain types of companies are going to be rewarded and there's excitement for them, and other types of companies there isn't. So if you're a tech-enabled services healthcare provider and you have 18 to 22% or 24% margin profile, and you want to go IPO, maybe there's some interest for you because of investors that need to invest in this category. But you're competing against companies that are growing, at a rapid click. Imagine, I'm not saying this is going to happen, but imagine if Cursor decided to go public, right? I mean, they're adding $100 million in revenue every few months. And let's say you're a company that has been slowly growing in healthcare technology and tech-enabled services, and you took you 14 years to get to 100 million. It's just, there's no comparison, right? It's not, part of it is that everybody else that's an AI company that potentially is looking to go public is a pure play tech company, or has deep margin profile, or is just hot for a number of reasons. And unless you are something that can compare to that level of excitement, it'd be a tough place to go public, right? I think it's a profile issue versus a demand and a desire issue on the company side.
Yeah, and then for a lot of these unicorns, their board told them to get to profitability fast 5 years ago instead of, and so they stopped being growth companies. And so now they're not growth companies anymore. And they're running out of cash. And now there's companies that are GenAI native are being born and have a GenAI tech stack. And then the old unicorns don't have the money to go and reinvent and rewrite their product and make it GenAI native. And so, and then they're also underwater in terms of management's equity. So management's leaving. So you have a company that doesn't have its CEO, is not a growth company, and has an old tech stack, and it wants to go public. And how exciting.
Yeah, that's exactly my point, David, right? Like, think about it imagine going to a dance where everybody's, health and fit and goes, they're just like, and then you got to show up and you haven't been healthy and you haven't been fit. Like, it's no competition. It's just that environment where there's just a lot of really strong new age companies that are generating some significant margins and profits, and customers that older companies just can't do. And I think they're going to be in this weird spot where either they're going to have to sell out to PE and somebody's going to have to kind of do a bunch of roll-ups, or in some rare cases, in a couple of years from now, if they can't go public, some of these Gen AI companies are going to go and buy these old assets out for pennies on the dollar. So I think there's a interesting risky transition happening from last generation of healthcare investments versus this generation.
And then the consolidation environments. I frequently have said that we've had under consolidation. So I date the beginning of the current long generation of healthcare innovation to 2009. 2009 was both meaningful use and the global healthcare crisis, with the Fed adopting a ZIRP, a zero interest rate policy, causing massive entrance of startups, products, capital, people, talent into digital health. Since then, we've seen under consolidation always. There's 100%. Always been consolidation. And there's a belief that we're finally going to see sort of the mother of all consolidations, some on good terms, some on, it's been under consolidation, also under rationalization. So companies that should have shut down, didn't shut down. Companies that should have sold out at an opportune moment didn't sell out because they said, we're going to become the new incumbent. We're going to grow and be that billion-dollar revenue company. So we've had under consolidation. And so there's a belief that now you've had prices in public markets have rationalized. You don't have, the incredibly high multiples of before. And you're finally going to see, and by product buyers, such as employer health tech product buyers or hospital CIO product buyers, they have matured and they know what they want now. And among other things, they tend to want suites, and the vendors don't always have suites, so they need to go and get suites. So there's a belief we're going to see consolidation. But I would say that even so, consolidation is still weak. You do see asset sales, which usually mean distressed asset sales happen. Yes. You do see an incumbent with a great sales team will buy an AI product that's shown some promise to be able to rapidly add AI to its feature functionality. So very selective, but I would say still weak consolidation. And there's a great hope we're going to see not just rapid consolidation to offer exits for people who are in industry, but we'll even see irrational consolidation. We'll see Google and maybe NVIDIA and maybe somebody and maybe Microsoft ride in and buy companies at high multiples. But I don't see that happening. What do you think is going to happen with is it maybe more of this sort of low paced select consolidation, or are we going to finally see consolidation pick up and make up for years of under consolidation?
Look, I don't, there's a hypothesis around that, and I think there's some possibility that could happen. But the first things first, right? I mean, you need a lower interest rate environment for any of this consolidation to happen, right? So first thing is that the cost of borrowing capital is just, it's higher than it has been in the last 15 years. And as such, the numbers just don't work as well. So I think part of it is that money's got to be a lot cheaper for some of this acquisition activity to be spurred. Second is that things that used to be really hard to build are much easier to build now. So if you had a competitor that had an application stack and you needed to hire 500 people and give them 3 years of resourcing to compete against that, now you could probably do that with 50 people and 6 months of GPU compute on coding and get that done. So the part of it is that what do you buy when you're consolidating? I think it's historically speaking, it's been around technology, but now it's probably less around technology. I think what you're probably going to be buying at this point are contracts or something to that extent. So I do think that consolidation is underdone, as you said, but I also think that the environment isn't fully conducive for it.
And I think you'll see some assets that are valued is strong existing sales. And so a company that sells a health benefit to 100 out of the Fortune 500 would love to buy another company that sells to 50 different ones out of the Fortune 500. That's a great sale. Or a GenAI company growing fast with a lot of capital backing could buy an incumbent who had for its contracts and its sales.
Bingo.
And we haven't seen a lot of either of those, but we may see that in the future. So
I think you'll see more of that in the next 24 to 36 months for sure. Right? I mean, I think there's a world where some of the startups in the healthcare space, that starts making sense for them to buy out incumbents. The incumbents have always tried to buy out, technology companies. I think it's the other way around, which is kind of a new phenomenon there.
So now switching to our next section of the show, which is business and trade journal news. And for our audience, feel free to throw any business stories you want us to comment on. So here we just talk about stories in the trade press that were of interest to us in the last week or so. And I'll just throw out one. I think it's a deal of the moment is Peer AI, an agentic AI platform for life sciences companies, announced it raised a $12 million Series A led by Flare Capital Partners, partner Ian Chang there, who I know, and also Signalfire. And this platform helps medical writers generate documentation for regulatory approval. So this sounds like a great use of GenAI. And envious, I didn't start this company. It seems like this is what investors are focused on, the kind of story investors are focused on right now. And this reminds me of we're talking now like three years ago, GenAI story, which was that the use case of GenAI is that you put 20 Seinfeld episodes, scripts into GenAI, and then you tell it to write the 21st episode of Seinfeld, and could it do that? And that's the analogy here is that you put a bunch of MedReg type documents that medical writers write into a proprietary database, and then you tell your engine to go write your next document, and then it does a 98% good job, and then you have an expert there who's correcting the last 2% to make sure. But the whole thing took the expert half an hour instead of 4 hours or 5 hours of their time to create this document. So I think that's a very sort of the moment deal. But were there any news stories of the last couple of weeks that you thought were worth telling our audience about?
I think not a couple of weeks, but I think it's probably been maybe over the last 4 weeks or so. I think the biggest news in healthcare, especially with generative AI and healthcare, has been this whole Epic deciding to come into the scribing space. So Epic decided that they're going to turn on a scribe feature as part of their EHR. And now doctors can essentially have a tool or a generative agent that listens along and creates a documentation and summarizes it. And then just like the use case you just mentioned with Peer, the doctor can spend 30 seconds reviewing it versus 5 minutes trying to type it all in. So I think that's major story, especially given that much of the excitement and interest and investment in generative AI over the last 3 years in healthcare has gone into scribing. Whether you look at a Bridge or Ambiance or some of the other players that have been in there. To me, I think that's a big game shifting story. And the question to me is that what does that mean for these existing players that built a business around a single use case? And now that single use case is kind of available. This kind of reminds me of when Microsoft started putting TCP/IP stack as a standard feature and killed Novell in some way, because Novell used to sell a TCP/IP stack for all those technology geeks that know what that means. But yeah, it's a let me just bundle this one more thing in there, and you could essentially take out an industry. And I wonder if that's actually going to happen, or if they're going to fight back the companies that have raised all this money and how they're going to do that. That to me is the one that I'm watching closely.
And also in terms of fundraising news, Capital RX raised $400 million. Do you have any thoughts on that deal?
Great company. I think, there's just a tremendous amount of momentum there. So it doesn't surprise me. It's really growth capital in their case.
And Reflection AI raised $2 billion. This is not a healthcare specific deal, but this represents the sort of I guess this is large LLM companies continuing to raise money and build out their capabilities. Any thought on what that means for healthcare or for AI?
Yeah, I mean, look, I think Giannis and team and Misha are doing an incredible job in sort of thinking about what I would call sovereign AI, which is a new topic that's going to come up. I had a chance to meet the founders a couple of years ago when they had just left DeepMind and were thinking about doing something in this space, and I think still kind of working through some of the process. So it's great to see where they've ended up. This is obviously the team that knows what they're doing. DeepMind was the place where most of the original AI research was being done before we had labs like Anthropic and OpenAI. So I think these guys come with the absolute great pedigree. I think their thesis is great. I think having a lot of countries are going to start thinking about not an open source, but openly sourced AI that is sovereign. And I think these guys have a plan to do something that's pretty incredible. And yeah, not surprised. I think they're going to, if there's an opportunity to have a game-changing moment in the LLM space beyond incremental improvements that we're seeing, I think this company is probably pretty well positioned to deliver them.
What does sovereign mean in that context then? It doesn't mean one per nation state or something.
I do think that that's kind of where the world is going to. I'm not commenting on whether what reflection strategy is or not. I mean, I think theirs is more broadly, but I do think this is a step towards sovereign AI. I see this across the globe right now, which is that people had thought data centers weren't important because you could rent one from GCP or Azure or AWS. And now people are starting to realize, hey, no, we want our own GPUs. It is kind of what if US decides to shut something off for us and we have no access to GPUs all of a sudden? What does that mean for our sovereignty? And I do think that there's a push by nation states, whether it's in the Middle East, like places like UAE and Abu Dhabi, whether it's China trying to build its own cluster, whether it's Europe kind of thinking about a little bit. I think there's this new push and towards building sovereign AI infrastructure and software, which means that you own the GPUs, you own the data centers, you own the network, you own the storage, and you own the LLM. And I see the world moving more towards that than not.
Really interesting. Thanks. Yeah. So there was, in the age of cloud, there was concern that, for example, Canadian healthcare data not be on U.S. servers, but AI is more strategic than that, and you might have Canada wants to ensure that it has, eyes that use Canadian dictionaries, use Canadian language, keep data in Canada, access as source materials, data sources that Canada approves of and can't be stopped or interfered with by any other country. That's really interesting.
Yeah, I think so.
So skipping forward in our plan a little bit to some other topics. So this is a crowd pleaser for our audience, but is there a technology that you use in your daily life that you recommend to our audience that has really improved your quality of life? And so my favorite example here is that a growing number of people are just repeatedly talking to voice mode of ChatGPT, which seems to do a really good job of understanding you, giving you advice back. It's not normal to people. They're used to going to Google and doing searches and reading the results in Google, and instead you're talking to someone. Another example is that modern sort of power station batteries for your iPad, laptop, and phone are just much better today than in the past and are very handy in keeping you mobile and having your phone never run down on the road, made by Anchor and that sort of thing. Are there any technologies in your life that cost a couple $100 or less that you would recommend to the audience?
Yeah, there's a company, there's a device I use. I should probably know the name of it, but it's like a credit card size device, and it almost looks like this, right? It's about this size, and it's a meeting recording device. You can put it on the table and have a conversation, like you and I could be having a conversation too, and it would be there. And then at the end of it, it has some modes where it can track sentiment, it can track how the conversation kind of evolved. It builds a lineage map a little bit on how conversation went from topic to topic. And sometimes when I have conversations with friends or advisors, even where I'm just topic, hiring or design, technology, innovation, product management, whatever it happens to be, it really helps me to have the conversation and then not worry about taking notes, right? And then, but ultimately, at the end of it, be able to sort of see how the conversation evolved. So I do like some of these devices that are scribes, but they do a lot more than scribing. They do sentiment analysis, they do lineage analysis, they track a little more about how conversations evolve. I think those are super cool.
That's interesting. So I would like the sound of that. And that's similar to having a call in Google Meet or a call in Zoom where you have an AI note taker listening as well, except it can be an in-person meeting. And it also sounds like those interesting form factors where they're trying to make a new device that sits in your pocket or something and maybe even has a video camera looking out and it's always listening to you and has no keyboard. And that's all those have failed as far as I can tell, but it's an obvious next form factor is to be carrying around a voice AI with you that knows where you are and maybe can look with the video camera. And that harkens back to the movie Her, if you remember Joaquin Phoenix falling in love with his operating system of his AI device. So really interesting.
I think less is more in this space, though. I think the second you put a camera on these things, it becomes a little creepy. Right. I think, the second you have always on recording, I think it becomes a little hindrance to adoption. I like something that I can put on the table. Everybody knows it's there. I can press a button, ask people, hey, I'm going to record this. Are you okay with it? Press a button and just a simple action of disclosing it, asking the question, I think makes it a lot more acceptable than something that's just there all the time.
Interesting. That's a great example for our audience. The next section is upcoming conferences. I think the conference everyone's thinking about right now is the Health Conference in Las Vegas next week, October 19th, 22nd. I think this is a great investor conference for our audience members with young companies. What I like to do here is I just write to all of the investors I already know, I've talked to, and all of the aspirational investors, and they're kind of in meeting mode. They want to do meetings during this conference, and so you have a good chance of getting a meeting with investors at this conference. There's a heavy representation of VC investors at this conference. The programming is also great. It's very informative. The programming also, if you have competitors, you can walk around the booths and see your competitors and their latest product messaging and marketing messaging that they have. It's good for those things. It's not a trade show, though. You're not going to find product buyers. That's a big weakness of it. You spend all this money, but it's not a trade show. So I like the health conference coming up. A big question is that we've been in sort of a 2 to 3 year slump in digital health. And so this is a conference that was known for its excesses 3 or 4 years ago. And with Cirque du Soleil serving you peeled grape hors d'oeuvres, and And now I think it's going to be kind of a bummer to go there and see, I think it's going to be, there's going to be fewer people, and budgets are going to be significantly lower at this event because we're going through sort of a headache at health. But I think it's still worth going to for intelligence and for meeting investors. So do you have any thoughts on health or any other conferences that you are definitely planning to attend or recommend people in the audience attend?
Yeah, look, I think the health, we're going to be there en masse. I think there are actually more buyers there than you realize. They're just kind of they're you have to sort of seek them out. Last year we went to health and we found a lot of new customer leads as well, because I think they were just they were just looking for new technologies. And so I do think that's a good one. I wouldn't worry too much about the sushi being second grade this year. I think there are plenty of VC firms with big fat checks throwing a lot of these parties out that wanted to talk to entrepreneurs. So I still think there's it's going to be a pretty hefty event. I like JP Morgan as well, because I think that's involved a little bit more from pharma to more healthcare to more, even some buyers are showing up at this point, not for the purpose of buying, but just for the purpose of learning. And that becomes a much healthier environment to engage with buyers, I feel like, versus some of those other trade shows. I like those. Vive, obviously, is another one. Health Evolution, I think, is another good one. Some of these are top of mind.
That's great. And then personal notices for the audience here. My next Boston Health Innovation Night is Thursday, October 16th at 5:30 at the Liberty Hotel. We have F Prime's Carl Byers talking about AI agents for your personal health and in the future. That's Thursday, October 16th. So coming up this week. Then, so Fawad, do you have any personal notices, events people can find you at, or are you speaking somewhere that people could hear about, or any personal notices for the audience?
Yeah, so UPMC is hosting an event at the health conference. I'll be speaking there. I think that will be a one. There'll be information about that on our website. So penguinai.co, you can find that. But that's one that I'm speaking at. I think a lot of the speaking engagements kind of kick in early part of next year at this point, because at the end of the day, as a founder, towards the end of the year, you just want to be closing business. So that's going to be where most.
So you're speaking at the health conference. I think that's going to be Monday, October 20th.
That is correct. And we're doing a session that is being hosted by UPMC. It's called the Vision to Venture, and I'll be speaking there, and then a couple other people will be there, including someone from a bridge and somebody from Google.
That's great. So now we move to the second half of our show, where we talk about the topic of the show. And so the topic of the show is the healthcare AI arms race. Payers and providers are looking for greater efficiency using GenAI. But what happens when they unleash the latest AI tools on each other? So let me just start off very generally. What is this AI arms race between payers and providers?
Look, I think, as we sort of talked about throughout the show, AI agents have the ability to do a tremendous amount of work at a very minimal cost. So these agents are being deployed on both the provider side and on the payer side. So for example, on the payer side, some of these agents might be deployed to review your claims. So if you're a physician, you submitted a claim, there might be an AI agent that might be sitting on the payer side, where when your claim comes in, instead of a human reviewing it, it's an agent that's going to review it and make an adjudication. Flip on in a similar fashion, you may be a physician or a clinic or a hospital that's also using AI agents to submit that claim. So we're rapidly emerging and getting to this world where the submitter and the reviewers, or in some cases the submitter and the approver, in some cases the submitter and the deniers, are all agents. And I think this is starting to happen very much right now. It's a trend that I see in the industry. It's still early days, but it is the trend where agents are fighting other agents. And we call these the agent wars, which Jeff started.
I've heard a joke about this, which is that hospitals are leveling up and payers are leveling up, and soon they're going to use all the world's compute. And then after that, they're going to use up all the world's electricity, but that the total amount paid in billings isn't going to change that much. So I don't know.
I think it's a fair way to think about it. But I think until you reach that equilibrium point where the payers and the providers are putting in equivalent amounts of agents and compute, I think there's an opportunity for disproportionate benefit. I think if the payers deploy the agents first and their costs go down, then, I think they win in the short term. Versus if the providers deploy the agents first and sort of leverage them to make repeated calls, to be able to, for example, appeal every decision that's been denied, compared to 3% or so what's typically the appeals rate. If they start doing that and there are AI agents on one side and humans on the other side, I think there's a disproportionate amount of advantage on one side versus the other, and the advantage is on the agent side.
So you had the chief data officer roles at Kaiser Permanente, United Healthcare, and Optum. What were the biggest administrative burdens you saw, and where would GenAI have the biggest opportunity to make a positive difference?
I think there are a number of areas where there's just a large number of humans, and these are clinicians in many cases, nurses and physicians, who are doing administrative work. So think of processes such as prior authorization. So a prior authorization is, for those who don't know this, which would be surprising, but is a request that a physician has to submit on your behalf before they can do a major procedure on you. And they have to make sure that the insurance company gives a thumbs up before they do the procedure, otherwise they may not get paid for it. So this is a process where it takes a significant amount of time for the physician or physician staff to build this document, which is called the prior authorization submission form. And it also takes a significant amount of time for the payer to review. So imagine you're United Healthcare and you have 60 million members, and each member is sending it requires 4 to 5 prior authorizations a year. All of a sudden, you have to do 300 million prior authorization reviews, right? And sure, some of those might be minor, and you can have classical data warehouses work on that. But in many cases, these are fairly complex things that end up on a nurse's table and then a doctor's table. So you have tens of thousands of nurses and doctors that are employed by these health plans just to review documents. To me, that is an unnecessary place to deploy large numbers of clinical staff, given that we have shortages of this staff in general in clinical settings. So those are the kind of examples that I would say: prior authorization, risk adjustment, claims adjudication, payment integrity, various fraud, waste, and abuse activities, revenue cycle management. I think these are the areas where administrative burden exists in large amounts and where generative AI can make a big difference.
And were you talking, so on the provider side, what would you say are maybe the top 2 or 3? And on the payer side, what would you say are the top 2 or 3?
I would say on the provider side, the big ones are around revenue cycle management. So medical coding. So when a patient comes in and you have an encounter, you have to now code this before you submit this. So I think that is number one, which is medical coding is a big one. I think there are others around revenue cycle management, including appeals and claim scrubbing and so forth. So other use cases like that. I also think that we've talked a little bit about scribing. I think that's a big one on the provider side. I think the third one is chart summarization, or being able to take a large chart for a patient and summarizing that into a single page for a physician to be able to review with all the salient facts before they see a patient. I think some of those are big ones on the provider side. On the payer side, I would say right now, prior authorization is probably the biggest one. There's some regulation kicking in next year, that requires payers to upgrade. So I think that's driving some of it. Risk adjustment, HCC coding is definitely another big one. And I would say, and then the payment integrity and claims are kind of tied for number 3.
So you talked about on the payer side, employing physicians and nurses to review claims. There have been many jokes about ChatGPT graduating from medical school or acing the boards or something like that. Can a large language model, which is sort of a language prediction model, can that accurately review a claim?
Yeah, I mean, look, I think we're sort of going to the world of what we call a mixture of experts. which means that there's not a single model that's at play. There are multiple models at play, different models doing different things. I think in an MOE setting, yes, absolutely. You can have a mixture of experts reviewing a claim. So for example, what does a claim file typically look like? Sometimes it's an EDI file with just information. Sometimes it's fax documents plus API calls plus, EDI files and things of that nature. So when a claim comes in like that, you could have a vision model that looks at the PDF to extract the information out of it. You might have a sentiment analysis model that sort of, reads other undertones in the submission. You may have a large language model just reviewing logic and guidelines. So yes, I do think that these models in the right configuration can do the work that is done today in a fairly manual fashion.
And for our audience, feel free to throw any questions in the chat that you have for Fawad. So, and you were at Kaiser Permanente and United, and you left to start Penguin AI. Can you tell us what the opportunity you saw was? What's the problem you're trying to solve?
Yeah, look, I think for me, the opportunity and the problem space has always been the same, which is that healthcare delivery is too clunky, too expensive, and too slow in this country. For the amount of money that we pay, all of us pay in premiums, yes, we do get great care at certain instances at the higher end of the market, but I think on average, we do not get great care. And the reason we don't get great care is because we built this system that is designed on classic processes from 40 years ago. And we're deploying a lot of energy and capital on just doing this approval cycle, right? Submission approval, submission denial, submission appeal cycle. And it's happening all over the industry. The net of it is that the patient's not getting care sooner. And there's a cost to not giving care to patients sooner. The cost is actually quantifiable. There's cost in terms of dollars. There's cost in terms of pain and suffering. So how do we enable an ecosystem using technology where some of these inefficiencies can be taken out of the system? That was really what was driving me to want to start Penguin and go after these chunky problems. I do think that for the longest time, the technology just didn't exist, could solve this in any sort of robust way. We could make 5% improvements or maybe 2, 3, 4% improvements, but not 300% improvement or 500% improvement. That has just come to bear over the course of last 3 years since we had language models come out and some of the other compute capabilities evolve. So now we can actually build a new system or at least improve the existing one and make sure that if you and I need care, that it's Friday, that it doesn't get delayed until Tuesday, that it happens on Saturday, that it happens on Friday. It happens, when the doctor's available, not when the insurance company is ready to review your prior auth. I think they're just foundational problems that we should be solving, and that's what we're going.
So there's a market of payers and providers for buying AI products and solutions, and we've seen products for clinical use of GenAI that's hit a kind of a bump in the road. And the bump in the road is that you usually want you want to be careful about diagnosis, and you want any kind of AI, any kind of supportive tool to be explainable. And GenAI has not been very explainable up to this point. And so you have an irony that it might actually be better, but not explainable. And so then the question is, do you take its advice? But that obstacle isn't in the way over on the administrative side where the problems are very large. But what have you seen in terms of buyers from payers and buyers from providers buying AI, and are they buying AI products, and where are they buying AI products such as Ambient Scribe or other areas, and are they getting stuck on issues when they try to buy and implement AI products?
Yeah, look, I think there's purchasing happening on both sides. I think there's been a major shift in the last 12 months. Last year in 2024, if you had asked me in fall of last year, I would have said both the payers and the providers are at best in kicking the tire mode. They would call you, they would want to talk to you, they would want to know. Their teams would take copious notes, but nothing would happen in any sort of meaningful way outside of scribing. I think that was the one use case which had gained momentum that was being adopted. Fast forward now, I would say the providers actually got the memo first. Q1 of this year, we started to see the providers and the health systems start to adopt revenue cycle management related agents first, because they saw, hey, if we use a Penguin agent, we can do the coding the same day as the encounter, which means that we can perhaps submit the claim within the same day as the encounter, which means that we can get paid maybe a week sooner than we typically do. So they saw the dollar values accruing there, so they started adopting that, especially around appeals and revenue cycle management use cases. I think what's happened in the second half of the year is that the payers are starting to get wiser, right? They're starting to realize. I mean, I had a CEO of a regional health plan talk to me and said, "Hey, for part of our network, we used to get 2-3% appeals rate on denials. Now we're seeing for that same part of the network, we're seeing 100% appeals rate, which means that there's something's changed on that side. We think they're using an agent to appeal everything we deny. By the way, we don't have agents, so we have to have James, Mark, and Joanna review every appeal they send us. And if that starts to happen in 30% of my network, that's not going to work. We're not going to be able to handle that kind of capacity. So I do think that the payers are starting to realize that just because providers are adopting, they need to match up at a minimum, not because they're trying to deny each other. It's just that if there are more requests coming in, then you either need to hire more people or have more similar AI agents dealing with it. So we're seeing the pickup on the payer side significantly in the second half of this year. But this is an evolving market. I mean, it just literally in the last 12 months, I've seen this thing go from tundra frozen to, somewhat excited to freaking out. It's really happening live in front of our eyes.
So that reminds me that there was a story that came out of the Bio conference, and an executive in contract procurement at a big biotech company said that they had plans to increasingly use AI agents for contract negotiations, and to increase the level from 10% to 25%. And then in the audience, someone raised their hand and said that they were with a vendor to pharma, and they had been using AI agents for contracting for 100% for a year now.
See what I mean? Yeah, exactly.
Let's see. So, and we have an audience question. It's Patricia again. So she asks, perhaps U.S. healthcare's problem is that it's focused on claims payment and profitability, which takes a lot of effort on transactional value and not on the care itself. The amount of focus on revenue cycle management and profitability, itemized claim by line, and the complexity is not found anywhere else in the world. Yeah, the U.S., the fee-for-service model has caused the system to optimize for fee-for-service. And so I was hoping that we would see a shift to fee-for-value, and we sort of saw the beginning of a shift, and then it got frozen, I think, by Tom Price and others, and Biden chose not to make that shift a big emphasis of his administration. And so we're still stuck sort of halfway in between. But I have a thesis, which is that under fee-for-service, providers don't want to buy technology. They want to employ expensive people to bill at high rates. But under fee-for-value, then providers want to get rid of as many people as they can and replace them with automation technology. And so a shift to fee-for-value would be great for tech vendors, not so great for clinicians, but we have a shortage of clinicians anyway. So this shift would benefit tech companies, but we saw this shift begin under Obama and then be frozen under the first Trump administration, and there's really isn't a lot of direction. So I don't know if you have any thoughts as to why there's so much emphasis on revenue cycle management in the U.S. system.
Yeah, look, I mean, we built this system for scale, not for efficiency, right? I mean, think about it. It's the 90s and 50s, and all of a sudden you've got one of the largest population that's becoming middle class, wants healthcare. So you look for a playbook. You look around the world. What do you see? Nothing. There's nothing that at this scale that we needed it existed that could be copied and pasted. So we built a system which is, it's no excuse for it, but it was a hodgepodge system, and it was really designed to be able to handle the scale. And so we did that, and it works in terms of that, but it's not efficient. It's not designed for value. It's not designed for care outcomes. It was designed for, having a large population that just came back from a war and needed a lot of care to be able to deliver that. And then the baby boom generation that subsequently came in. So I think I do agree with you. My fear here isn't that, it's bad enough that we have this system. My fear is that we're starting to export this now, just like we do many other things as the United States of America. We are now starting to export our systems, our healthcare system. Now you go to other countries and they have prior auths, and they have denials, and they have claims, and they have, medical necessity reviews, and all the things that plague our system are now starting to pop up in other markets in Asia, and especially in Asia. Europe probably had a little different of a system, but Asia, this is starting to happen. So I worry. I worry about not only us causing our own challenges and needing to fix it, but also trying to export this system that probably isn't ideal.
Yeah, and Patricia, I'll just add to that when you buy an iPhone, you are the buyer, the user, the decision maker for that iPhone. But in healthcare, it's the most divided world of any major industry, where the buyer is not the user, is not the decision maker, and they would make very different decisions, and they don't have each other's best interest at heart, and they often don't like each other in healthcare. So, but the buyer is the payer, and the decision maker is the provider, and the user is the patient in healthcare. And the patient might like to have the very best of everything and not have to pay for it, and they would be more restrained if they had to pay for it dollar for dollar out of their own pockets, and they'd know what it costs, for example. And so part of this is dealing with the inefficiencies, trying to make an ethical, good healthcare system despite the adverse incentives of the different players in this marketplace. So now I want to address a couple AI controversies and how they affect healthcare. So one of them is that we've had many tech waves. So cloud was a wave, and mobile was a wave, and just browser was a wave, putting apps in the browser. And in those ways, it seemed like challengers had an advantage somehow. It's not clear what the advantage always was, but that incumbents were stuck. And it might have been classic Clayton Christensen style disruption, where there's a new business model with possibly lower margins, and so the incumbent literally can't get anybody inside the organization to want to take the incumbent toward a lower margin business model. It could be other reasons, but we kept seeing challengers win. And now there's a new claim that actually in GenAI, incumbents have the advantages. And so what are those advantages? Well, you need data assets to be competitive. And so some incumbents have prime data assets, not all of them, but some of them do. But a challenger probably has to go get a data asset, maybe pay for it. Maybe they can't get a great proprietary data asset. And so that's one issue. Distribution. So incumbents presumably have great distribution already, and challengers have to go and build that distribution network. And then also in today's environment, fundraising. So it's a high interest rate environment that a lot of venture firms are in trouble. In the past, a team could go and raise $100 million supposedly quite easily. Today, it'd be much harder for that same team to raise that. But a profitable incumbent does have access to maybe to public markets, maybe to easy debt financing, to other low capital sources in today's environment. And so those are some of the advantages. And so you see this play out with Salesforce.com most notably, but also with Epic, where they simply announce, we do all that. AI, we do that. What did you want with an AI? What kinds of AI products did you want? We do that. In fact, here it is. We're rolling it out. It's named something or other. It's not ready just now, but it will be ready soon. And so what do you think about this claim that unlike prior tech waves, with GenAI, incumbents have the advantages?
Yeah, I think if you're in the pure tech space, meaning if you want to build a new language model, or if you want to be a research lab in AI, it's absolutely good to be the incumbent. It's good to be Google. It's good to be AWS. It's good to be Azure. Microsoft, and so forth, because just the CapEx requirement to train some of these models is so in the billions, and the expertise required to be able to stack and rack and source the energy and all that. It's a complex business, right? It's not a classic software business where you turn on a bunch of CPUs and you code. It's a training model. So I think in those cases, incumbents do have an advantage. No question about it, because you're creating new technology. You need the capital, you need the compute, you need the data, you need the distribution, and you need preferably a very, very high margin business that you can use to offset the cost of investment in some of these areas. So I think that is absolutely true. I think when you go downstream from that to specific industries such as healthcare, and let's take an example of a large EHR provider. Let's call them X. And they have 250 large health systems as customers, and they've been around for 35 years, and they have deep contracts. If you ask me, do they have the advantage or not? I would say they are absolutely disadvantaged. And the reason they're disadvantaged is the same things that Clayton Christensen and sort of outlines in the innovator's dilemma, right? They have 30-year-old technology underpinning everything. Yes, they have the data, but it would take an act of God and maybe hundreds of $1 million of resources to even normalize that data within these environments. Some of these companies are running on COBOL databases. So, putting on a generative AI wrapper on a COBOL database, I just don't see that happening. So I do think that you're going to see a lot of the lipsticking of the pig happening in the downstream, where you're going to see a lot of, yeah, we do that, or we're no longer a classic EHR company with 35-year-old technology. All of a sudden today we're AI agents, and that solves all problems. That's just not true. As somebody that has worked in large organizations, managed some of the largest implementations of EHRs and claim systems and risk systems and like the whole thing, I can assure you that a lot of the incumbents are truly disadvantaged to a point where they have to do a lot of tech debt relief before they can actually start to leverage the latest technology in any sort of meaningful way. They might be able to do cool demos. They might be able to sort of show you a whiz-bang agent that works in a very, very defined environment, but to re-architect their platforms for a generative and an agentic healthcare world, I just think is going to be enough.
Interesting, thanks. And so another controversy I've heard is that, to use software, you have to learn a user interface for software. And there's people who've been using Word for years and they still don't know some of the functionality or have trouble with mail merge in Word, or there's people who've been using Salesforce.com for years and they still understand some of the ways to generate reports or to automate actions in that. And so I've heard that in the future, the user interface might simply be the AI prompt. So whatever you want, you just write it there, and then it will take all further actions for you, so that you don't have to memorize. And then some people have trouble switching from Salesforce's marketing engine to the competitor's marketing engine, but you don't have to worry about that anymore because the user interface of the future is the prompt.
Yeah, I think there's some truth to that, but I also think that, do not underestimate people's desire to not change, right? So I think somebody that spent the last 25 years learning the ins and outs of Adobe Photoshop and knowing where all the options are isn't going to give that up just because they can write a better prompt. I just think that that's going to be an uphill battle. I think another version of what you describe is that the user interface will be whatever you want it to be. Right. So sure, if you want it to be a prompt, it could be a prompt, but you could ask it to be like, hey, you might buy a new marketing software or CRM, but you don't want to retrain your organization. You can ask it, your users or agents could say, I want it to look like a Salesforce version X UI, and it'll just show it to you in that format. So I think the reality is that it's going to be less one thing and more of the thing that you're the most comfortable with. And for an LLM to create a user interface that looks like X, which it's seen before, is maybe $1 worth of tokens, maybe $5 worth of tokens. But you build that, and you build that once, and then if it gets reused, then that's the best $5 worth of tokens you've used because you don't have to retrain your workforce. So I do think that there's a little bit of that evolution that we're going to see in the next 12, 24 months, where the user interface is going to be whatever you like it to be.
And another controversy in the market is that there are these AI-led companies that have a single product, and now they've had a hit product, and this could be like a bridge in ambience. And now apparently what they're going to need to do is rapidly develop a suite, and then maybe even try to be the next platform. And then on the other side, you have the incumbents who already have platforms, but they're older technology, and they're rapidly trying to add the product that is threatening them right now so that they can claim to have that as well. And so the ultimate example of this would be, say, Epic versus a bridge. But this is going to play out in a number of ways on the provider clinical side, that's EMRs, provider financial side, that's RCM, maybe also on the payer side with claims management. Who do you think is going to win this battle?
Look, I think one thing is easier to do than the other, right? So for a point solution vendor to now be able to build an entire platform is probably a pretty heavy lift. For a platform vendor to be able to put a little lipstick on an agent is probably a lot easier to do, right? So I think the reality is that it's a disproportionate fight, right? If you're in a bridge or somebody like them, and you have raised $1 billion or $700-800 million, whatever it is, and you have 100 implementations, but every one of those 100 implementations has an incumbent that just turned on a competing product. And by the way, their product, the incumbent's product, is even more integrated with the incumbent's platform than yours will ever. Like it's a tough place to be for all of a sudden to expect the same incumbent is going to open their kimono and give you access to all the other areas that you could start competing with them on. It's just, I think it's an uphill battle for the small players in its own way. Now it's an uphill battle for the large players too, because they have an old tech stack and they got to figure out how to modernize the hell out of it. So I think it's a little bit of a play. It needs to be played out. I think, and I'm biased here because we took this approach, which is that we decided to build an agent first and agentic healthcare AI platform from the beginning. We didn't decide to do single one use case and then decide to add 3 more. We built the platform fully expecting to do 8 or 9 use cases on top of it. Therefore, we built the foundation right so that we could support that. Therefore, now we can easily bolt the solution on one at a time. I think that, personally speaking, is a much better approach. I am biased. I think that is better than being the incumbent and better than being a point solution. I think there are advantages to both sides, but I prefer that.
That's great. And any other thoughts on the healthcare AI arms race for our audience? And for our audience, any last questions for Fawad?
Yeah, look, I think the AI race is it's just getting started, right? I think part of it is that it's hard to infer too much today, because anything we say today, by March of next year, we're going to be looking back and listening to this and saying, oh my God, how ill-informed were we? Because it's so, like, I saw this happen with my own eyes in the last 12 months. Literally, there were crickets when we knocked on doors and talked to people about AI agents. And it was just like, meh, was the best case scenario reaction you would get. And then 2 quarters later, people get excited. 3 quarters later, people start knocking on your doors. 4 quarters later, people are knocking down your door. Like it's happening right in front of our eyes. So I think there's a lot of learning that has to happen on the customer side, a lot of learning that has to happen on the industry side and the software developer side. So I would say just it's early innings, lots of game to be played still, and I predict that whatever we predict today will be partially wrong in 6 months. That's where I leave it.
That's great. Well, thank you so much for coming on our show. You've been listening to the Digital Health Investor Talk show with host Stephen Wardell, and many thanks to you, our guest, Fawad Butt, the founder and CEO of Penguin AI.
Thank you for having me.
And so we'll be publishing this show as an episode of the Digital Health Investor Talk show. Subscribe on Apple and Spotify. Don't forget to rate us. And our next show is coming up on Wednesday, the 15th, with Dr. Sohail Sadat of GenieMD on key insights on longevity that you need to know. Thanks, and we'll see you at the next event. Bye-bye.